A few years ago, I made one of the worst financial mistakes of my life. I trusted crypto influencers, and that decision cost me over $10,000. Now, if you're thinking, who would actually lose that much money listening to influencers? Let me tell you something. At the time, it felt completely logical, because during that bull run, it seemed like everyone was making money, except me. And that pressure is exactly what led to the mistake. So in this video, I'm going to tell you exactly what happened, what I did wrong, and the 3 lessons that would have saved me $10,000. If you're new to investing, this might save you from making the same mistake. When I first started investing, I wasn't wealthy. Not even close. I was making around $1,700 a month, and I only had about $500 saved. Like a lot of people, I just wanted to improve my life financially. I didn't want to stay stuck working forever with nothing growing on the side. So I started looking into investing. And that's when I discovered crypto. At the time, crypto was everywhere. YouTube videos about it, TikTok clips, Twitter threads. Everywhere you looked, someone was talking about the next big coin. And what made it even harder to ignore was the screenshots. People posting profits. $5,000 gains. $20,000 gains. Sometimes even more. And when you see that over and over again, you start thinking one thing. Maybe I'm missing out. This is something a lot of beginner investors experience. It's called FOMO, fear of missing out. And it's one of the most dangerous emotions in investing. Because when you feel like everyone else is winning, you stop thinking clearly. You start thinking emotionally. Instead of asking, is this a good investment? You start asking, how fast can I get in? And that's exactly the mindset I had at the time. Eventually, I started following a few crypto influencers online. These individuals seemed extremely confident and exuded an air of success. They communicated with a certainty that suggested they had already figured everything out. They would make assertions like, this coin is about to explode, or proclaim, early investors are going to make life-changing money. Statements like, this is the next big opportunity became a regular part of my daily routine. When you hear such messages repeatedly, they begin to feel increasingly believable, almost as if they are inevitable truths. So, I took a step that many beginners often consider. I began investing in the projects these influencers were endorsing, drawn by their promises of wealth and success. At first, the market continued its upward trajectory. Consequently, my investments started to appreciate, reinforcing my belief in the influencers' advice. This initial success is precisely where the trap begins to close in. When you see early profits, you are likely to assume that the guidance you followed must be sound. Yet, it's essential to recognize that some of this success may just be the result of timing and luck, with much more complexity lurking beneath the surface of the cryptocurrency world. Here's something most beginners don't realize. During a major bull market, almost everything goes up in value, including a myriad of bad projects alongside the good ones. In fact, even projects that arguably shouldn't exist at all tend to thrive during such times. This phenomenon creates an illusion of success and competence, making many believe they possess exceptional investment skills. It's not uncommon for influencers and pundits to appear extraordinarily savvy, riding high on the wave of market gains that elevate all boats, regardless of their quality or potential. However, this buoyancy masks the inherent risks and poor decisions that often lurk beneath the surface. When the markets are rising, it becomes challenging for investors to discern which projects have genuine merit and which are merely benefiting from the prevailing trends. As a consequence, many people may overlook crucial due diligence, mistakenly attributing their financial success to skills rather than to favorable market conditions. Ultimately, as history has shown, reality has a tendency to catch up with investors. When the inevitable downturn occurs, the distinctions between solid investments and mere speculation become painfully apparent, often leading to significant losses for those who once felt invincible in their choices.
Then one day, the market started dropping. At first, it didn't seem serious. Many influencers were echoing similar sentiments. Buy the dip. This is normal. Smart investors are loading up right now. I took their advice to heart and held on to my positions, thinking this was merely a temporary setback. However, the reality began to set in. I wasn't invested in strong, long-term projects that had a solid foundation. Instead, most of what I owned were hype coins. These were the coins that were trending online, continuously promoted by influencers whose motives were often questionable. When the initial excitement dissipated, so did the prices of these tokens. The volatility that had initially attracted me faded, leaving my portfolio vulnerable. As prices plunged, I began to understand the importance of having a diversified and well-researched investment strategy. Rather than chasing trends on social media, I realized that long-term stability usually comes from investing in projects with real utility, a dedicated team, and a solid roadmap for the future. Moving forward, I recognized the need to reassess my investment philosophy and focus on assets that could withstand market fluctuations better than those driven purely by hype and speculation. It was a tough lesson, but one that would shape my approach to investing for years to come. I remember checking my portfolio one day and realizing something was seriously wrong. The numbers kept dropping, each decline seemingly more alarming than the last. Day after day, I watched helplessly as my investments plummeted, a cycle of despair taking hold. Eventually, the losses added up to more than $10,000, an amount that felt staggering. For someone like me, making around $1,700 a month, that kind of loss hits hard. It reverberates through every aspect of life, creating a cascade of stress that is difficult to manage. This financial blow affected not only my savings but also my ability to enjoy life's simple pleasures. The sense of security I once felt dissipated, leaving me on edge. Not just financially, the toll on my mental health was significant as well. Sleepless nights became routine, my mind racing with anxiety and questions. I frequently found myself staring at the ceiling, asking one painful question: how did I let this happen? Each reflection only intensified my frustration as I desperately searched for answers and ways to prevent such a situation from arising again. The journey to recovery felt daunting, filled with mixed emotions and a desire to regain control over my finances and peace of mind. After that experience, I spent a considerable amount of time trying to understand where I went wrong. Upon reflection, I identified 3 major mistakes that were responsible for my loss. If you can avoid these 3 pitfalls, you will already be ahead of many beginner investors in the current landscape. Mistake 1: trusting influencers without doing research. This was likely my gravest error. Numerous influencers online excel at one critical thing: capturing attention. However, capturing attention and being a knowledgeable investor are 2 fundamentally different challenges. Some influencers may be financially compensated to promote specific projects or cryptocurrencies. Others could have invested in these assets early on and are now encouraging others to buy in after them, thereby inflating the prices for their own gain. Additionally, there are cases where some simply provide misguided information. Blindly trusting their opinions can lead to severe consequences as you fundamentally relinquish control over your financial decisions. Allowing someone else to dictate your investment choices is an inherently risky maneuver. Mistake 2: investing based on hype. In today's digital world, when something is trending, it may give off an impression of safety. Nevertheless, history has shown that hype typically peaks at the top of market cycles. This is the juncture when new investors often enter the fray. Unfortunately, these inexperienced investors frequently become the ones purchasing just before a drop in prices occurs. Truly effective investing is not about chasing what appears to be popular or fashionable. It requires a deep understanding of the assets you're buying into, along with a clear rationale behind each investment decision. Mistake 3: not having a strategy. Reflecting on my past approach, I came to realize that I lacked a coherent investment strategy. I was primarily reacting to news headlines, social media tweets, and YouTube videos, making impulsive purchases simply because someone claimed that a particular asset was poised to rise. Successful investors operate with intention and clarity. They have a well-defined plan, allowing them to diversify their holdings across various asset classes. They also think long-term, understanding that investments require time to mature. Developing a robust investment strategy is vital, providing direction and enabling you to navigate market fluctuations with confidence and foresight. By learning from these mistakes, you can cultivate a more disciplined and informed investment approach that stands the test of time and market volatility. Here's something that might surprise you. The most significant investing successes often do not stem from chasing the latest trends or the next big thing. Rather, they come from a commitment to consistency. Engaging in slow, methodical, and disciplined investing may not have the thrill of jumping on viral crypto coins, but over time, it proves to be far more reliable and effective. This approach emphasizes the importance of patience and long-term thinking. Many successful investors have built their wealth through steady accumulation and a focus on fundamental principles rather than seeking quick wins. By adhering to a consistent investment strategy, one can weather the ups and downs of the financial markets and avoid the pitfalls of impulsive decision-making. If I had recognized the value of this approach earlier in my investing journey, I likely would have made wiser decisions and, consequently, could have avoided losing that $10,000. Investing is about forging a path based on research and strategic planning, not playing a game of chance. By cultivating a disciplined mindset and a long-term outlook, anyone can enhance their chances of achieving financial success and stability in the ever-changing landscape of investments. The good news is that mistakes can also be powerful teachers. After that significant loss, I made a conscious decision to stop chasing the latest hype. Instead, I dedicated my time to truly learning how real investing works. This meant taking the time to understand risk in a comprehensive way. I began to embrace the concept of diversifying my investments, which allowed me to spread my money across various assets rather than relying on just one or two. By shifting my focus toward long-term financial growth, I was able to develop a more sustainable strategy that would serve me well in the years to come. Over time, these thoughtful changes significantly helped me rebuild my finances and, ultimately, reach a much more stable financial position than I had previously enjoyed. I came to realize that education in financial matters is invaluable, and I regretted the hefty $10,000 I paid for that lesson. Now, I aim to share my insights with others, hoping that they can learn from my experiences without bearing the same costs. In doing so, I aspire to empower others to make informed decisions and cultivate a healthier relationship with their finances, promoting financial literacy and responsibility for the future. If you're new to investing and you only remember one thing from this video, let it be this: be extremely careful about whom you trust online. Just because someone appears to be successful does not mean that their guidance will lead you to the same success. The world of investing is filled with various opinions and strategies, many of which may be incentivized by personal gain rather than genuine intent to help others. It is crucial to conduct thorough research, analyze different perspectives, and carefully vet the credibility of sources before following any advice. Real investing is not about chasing trends or quick wins. It requires a steadfast commitment to understanding market dynamics and a willingness to learn from both successes and failures. Patience is essential because meaningful growth often takes time, and knee-jerk reactions to market fluctuations can lead to poor decisions. Additionally, establishing a solid foundation in financial fundamentals will empower you to make sound choices aligned with your long-term financial goals. Remember, investing is a journey, and cultivating the right mindset is just as important as acquiring knowledge and skills. Ultimately, take your time, stay disciplined, and approach investments with a well-informed perspective. Look, losing $10,000 was painful. But honestly, it was the most valuable lesson I ever paid for, because it taught me something most new investors learn too late. In investing, protecting your money is more important than chasing hype. If you're someone trying to grow your savings, starting with a few hundred or a few $1,000s. This channel is for you. Every week, I break down real investing lessons, real mistakes, and real strategies, so you don't have to learn them the expensive way like I did. If that sounds helpful, hit subscribe. And if you want to see the 3 investing mistakes beginners make that destroy their savings, hit that subscribe button, and I'll see you in the next one.